Thanks for staying. Welcome back to the marketplace. Now, government has justified the proposed tax measures outlined in the mid-year review. Finance Minister Ken Ofori-Atta insists it is required to put the economy on a strong footing. He, in the review yesterday, also maintained that these proposals were necessary to deal with revenue challenges facing the country. There's more in the following report.
The finance minister in the budget review noted that revenue for the first 5 months of the year were down by 1.1 billion cedis against the 18.8 billion cedi target. Ken Ofori-Atta further outlined several measures which sought to tax persons that earn more and create the room for low-income earners to be spared these tax hikes. He's also planning to be heavy on compliance, which will bring in about 1.5 billion cedis. But this has not gone down well with some businesses who have argued that it would worsen their sorry situation. But the economic advisor to the Vice President, Dr. Gideon Boaku, disagrees.
Our major concern is not to satisfy some businessmen at the expense of the majority of the consumers. When VAT was introduced, the NHIL component and the other component, the get fund component, were supposed to be sales tax. Okay, their component was supposed to be sales. But in the actual implementation, the treatment has not been to the effect that they are sales. And so we have businesses, as Mr. Tepe puts it, who are claiming the input component of the VAT. Okay? And at the same time, the output component, and only paying to government the output component.
But the minority spokesperson on finance, Keza Latufosin, is unconvinced by government's argument, maintaining that it would increase cost of doing business, prices of goods and services.
And that is why I'm saying prices of goods and services will go up by 5% because of this very tax handle. If it is not going to bring in additional revenue, they wouldn't have announced it. I've assessed it, and the revenue flow will be around 800 to 900 million. So I'm saying that we shouldn't celebrate yet. In the coming days, the bill is going to come before us in Parliament. We are going to assess it. We'll know the revenue impact, and we'll let the people of this country.
So what are the independent actors saying about these tax measures? Well, economist Courage Mate is worried that it could have a negative impact on inflation and gains realized so far.
Well, I saw a fiscal framework that was on the knife's edge, so that if we didn't do these adjustments, we would very likely miss our targets. And the implication of that is that it would have been difficult to sustain investor confidence, because remember that we would have exited the IMF program next year.
Okay.
And so if you miss your target upon exiting the IMF program, we should have made you achieve your target, and you were missing it at the end, then investors would be very apprehensive about what the outlook holds. And so it was necessary for these adjustments to be done in order to keep the framework on track for us to meet our target at the end of the program.
Some have argued that time would tell whether these measures will in the medium to long term hurt or turn around the fortunes of the economy.
So the Minister of Finance, Ken Ofori-Atta, also emphatically stated that there will be no increment in the value-added tax. However, he announced the National Health Insurance Levy and the Get Fund Levy have been restructured into separate taxes. Among others, Ken Ofori-Atta also raised personal income tax to 35% for persons receiving incomes above 10,000 cedis. Now, there seems to be some confusion surrounding the implementation of these new tax measures and how they could impact businesses. My colleague George Wiafe has been speaking with chartered accountant and financial consultant Dr. Daniel Sedo, who has been calculating the exact figures and its real effects on the economy.
So yesterday, the Finance Minister, Ken Ofori-Atta, presented the mid-year review. And one of the key things that has kept all of us talking, it's about this whole tax or the VAT, actually, whether it has gone down or it's gone up, and what will be the real impact on you as a consumer, or if you are a businessman, what is going to happen to you. So today, it's more about the VAT Class 101, or getting some deeper understanding of what this will mean for you if you are a businessman. Dr. Daniel Sedo, he's a chartered accountant, a financial consultant, and he's trying to help us to really appreciate this thing. Doc, thank you so much for coming on Business Live. Help me out. So What does it mean with respect to this whole arrangement? Has VAT actually gone down? Has VAT gone up? And what will be the real impact on me as a businessman and as a consumer?
Okay, let's put the discussions in perspective. What the government seek to do is increase revenue to be able to pursue the agenda. So that is it. The objective is increase revenue. But in doing that, I think they were clever enough to have some arrangements that will help them achieve their objectives. So you see that what they have done is to say VAT is no longer 17.5. It's now 12.5. One would ask, if the VAT rate is going down, how do you then achieve increase in revenue? Except you are anticipating that the activity levels will be high, and so even if you use a lower VAT rate, you would achieve your higher revenue. But that is not likely. Okay. Now, the second level is then to introduce what they are calling the straight levy of 5%. Yeah. So you can do the computations easily. Okay,
so help us get the computation right.
Yes. So let's say it costs you 80 Ghana to produce an item, and at the next level, the value that is being added in monetary terms is 20 cedis. Okay. So if you're going to pay VAT in the old regime, it will be 17.5 on the 20 value added.
To the product?
Yes. So your VAT 17.5 on the 20 cedis is 3 cedis 50 pesos.
So that is for the producer?
Yes.
Okay.
So that is what it will cost you as the consumer in terms of tax. The money you are giving away to government in the name of VAT will be 3 cedis 50 pesos. Now, if you use the same cost structure in a new regime, you will see that...
In a new regime where they are saying that VAT is now 12.5%. Okay.
Thank you. So the value added remains 20 Ghana.
Yeah.
So 12.5 on the 20 Ghana will give you 2 cedis 5 pesos.
I would say that's a reduction, right?
That is a reduction.
Okay.
So we move from 3.5 cedis to 2 cedis 50 pesos. So that is a reduction.
On the value addition?
Sure.
Okay.
That is a statement of fact. But there's an add-on, which is now a straight levy, which is, let's say, combine the two things, which gives us 5%. The insurance and then the
GET fund.
The GET fund. Okay, that is 5%. Now that 5% is now applicable not on the value added, but the cost.
Why is it now going on the cost? Because we thought that this whole VAT thing was the value addition.
So that is why they are telling you that VAT has gone down. So this one is no longer VAT.
Okay. It's a specific tax.
Yes. It's a choice of words and instruments. So they move from VAT to levy. So the levy now is 5%. So when you apply the 5% on the 80, you get 4 cedis. But in the same transaction, there's VAT, which is 2 cedis, 5 pesos. So for the same transaction, now you are paying levy of 4 cedis and VAT of 2 cedis, 5 pesos. So the total tax for you as an individual in this transaction is now 6 cedis, 5 pesos. The same transaction previously
was 3.5, 3 cedis, 50 pesos.
Now it's gone to 6 cedis, 50 pesos.
Interesting. So it means that even though on the face value, VAT has gone down, with the application of these two items being a specific tax, I am going to pay more.
Certainly that is the intention, to get a lot more revenue.
So then it's not fair to say that VAT has gone down, or the tax has gone down.
Well, it depends on the instrument you are describing. If it's VAT as an instrument, it's gone down. But it's gone down, the trade-off is that a new levy has been introduced. And it's the same person who is paying the two. So for you, the consumer, something has happened.
Let's still restrict ourselves to the producer level as well. In the incidence of taxation and then the rationale of taxation and all those things, can we say there's some element of double taxation here? Because I'm doing VAT and I'm doing this in the same value chain of production.
No, the producer really doesn't matter, because the producer in the old regime, there's input VAT, output VAT, which is net off. It has changed from 17.5 to 12.5. The principle is the same, net off. The real challenge is on the consumer. And the issue...
Why is it on the consumer? Because the producer is likely to pass on this cost to me as a consumer. Now, let's just say for you here, you are the producer. I'm the consumer, consuming maybe this drink that we are producing here.
So there are two things that could happen. The producer says, well, my margin is good. I can absorb the tax. So therefore, let me change my cost structure. From the 80, I can drop it to 60. So the incidence of tax will change. Or my cost structure is fixed. Nothing will go down. I need to pass on the tax to the consumer. If the second one is what the producer chooses, then the consumer will pay a lot more. All this thing we are talking about is consumption tax. Now, what is likely to happen if the taxpayers are sensitive? They will decide where to buy their items from, the formal system or the informal system, because VAT and the levy normally are not charged on the street. So if I can buy the item on the street, fantastic. But if I go to the malls, I'll be caught in this.
What do you make of the whole rationale behind this taxation? Because some are saying that it is not fair, it's deceptive, and all those things. It's not an innovative way of raising taxes.
Look, that is a bigger conversation we need to have, because tax is something that nobody will run. We need to generate revenue. That is a fact. If we generate activities and we make profit, we must pay tax on the profits. We need to get ourselves educated with those principles. Okay, but you need to ask yourself, are we productive? And are these taxes being levied on the profit we generate? The pain is that we are not productive and we are being taxed. What is happening is that our disposable income is reducing. Disposable income reducing means the support we used to give to the extended family will be affected.
Look, you brought in another interesting thing, which I also want us to look at, is on this 35% tax again on somebody who is earning 10,000. Now, help us out here again, because I knew that if I'm earning maybe even 200 Ghana cedis, I'm already paying some level of tax here. So if maybe like 2 years ago, I was earning 200 Ghana cedis. Now I've graduated to 11,000 Ghana cedis. Am I being charged on the 200 and then the extra 10,000 or 8,000 I'm also being charged on, Doc?
The pay as you earn tax is a graduated system.
Can you help us with that?
Okay, yeah. It's a graduated system. You see that there's a lifeline where there's no tax, then you move it gradually. The upper limit rate is 25%. Now, government says they are moving the 25% to 35% for those that would be 10,000 and above. So if the upper limit previously, that is per interpretation, will be 9.999. Once you hit 10, it's an addition of 1. We want to use that to illustrate. We would say, let's say 11.
Okay.
So you have 11,000. The benchmark, let's say, for simplicity, we'll say 10,000. So the difference is 1,000.
Yeah.
Now this is what is now going to be taxed at 35%. But the only thing that comes in is the 5% SNIT. SNIT is 5%. So 5% here will be 50. Am I right?
Yeah.
Okay. So your 950 will be taxed at 35%.
So any additional income that I get over the 10,000, I'm being taxed. So let's say every thousand is being taxed 35%.
Good. Any additional income you get, you deduct 5% Social Security, and the rest is taxed at 35%. Let's say you are 20,000. Okay. Now at 20,000, we take out 10,000. So your 10,000 is now the issue. There's a SNIT
5%.
5%. So that is 500. Yeah?
Yeah.
So you have 9,500 at 35%. That is really significant. We can punch
a calculator to also get a fine this sort of how this would actually work. So right now we're doing the 35% on the 9,500 and trying to get how that will be worked out in terms of the, yeah.
So here, if you are earning 20,000, your additional tax would be 3,325 Ghana cedis.
That's a lot of money.
Of course, the essence is to raise revenue. And the essence is we are interpreting these people to be the affluent people. Now, the challenge we're going to see, which we need to engage ourselves and discuss, is this. Now, when I was being paid 20,000, my take home was higher. Now, with the introduction of the 35%, my take home will reduce by 3,325. So I'm worse off. I need to have that conversation with my employer that, hey, now I'm worse off. So you need to increase my 20,000 to a figure that will restore me to my old level, take home level. And when that happens, the wage bill will go up. When the wage bill goes up, the profit margins will drop. The corporate tax will drop. You can't eat your cake and have it.
So this would also have an impact on businesses in terms of their profits and even whether the ability to pay, and also a human resource angle as well.
Certainly so. Taxation is cash flow issue. Wages, cash flow issues. So tax, you must generate the money to pay. Wages or salary, you must generate the money to pay. So it's a cash flow issue.
Is the tax approach a prudent one, looking at the structure of our economy and the structure of our businesses in this country?
Again, the bigger conversation is to generate productivity or production. We must go into doing things that will grow the economy, not taxation. The mantra previously was production, not taxation. But unfortunately, because there's a shortfall, let's just hope that this is a medium term or a stopgap measure. I believe that as we generate a conversation and we are getting to the end of the year, we are looking at 2019, probably these things will change. This will not help us in the long run. We should focus on creating new things, being productive, making profit, and then paying the taxes on the profit, not this one.
Well, so that's our taxation class trying to get some understanding about these whole taxes. We've seen here about the old VAT, how it's been calculated, the 17.5% on the original cost of the product, the value addition, and this is what we had. Now, the interesting thing is about how this new VAT is being calculated. Yes, VAT has gone down 12.5%, but the levy of 5%, how that is going to impact on the original cost of the product and also the VAT as well that we are paying, the 2.5% and all those things. You're seeing that, how that will be calculated, ending up in 6.5% or 6 cedis, 50 pesos. So yes, VAT rate has gone down, But with the addition of these levies from ad valorem, if I'm right, specific tax, it looks like the cost is going to go up. And who is going to pay for this cost? The producer might not absorb it, but is going to pass it on to you as well. From our Taxation 101 class somewhere in Accra with financial consultant and chartered accountant Dr. Daniel Settle, this is George Yafi trying to get some education on this tax. Over to you guys. The debate, I know, is still going.
Thank you very much, George Yafi, for that incisive analysis on the tax measures introduced by the Finance Minister in the mid-year budget review. Now, away from that, the Food and Agriculture Organization, FAO, is urging government to invest into aquaculture to help meet the expected shortfall in fish supply, as well as to create more jobs. This comes as the Ministry of Fisheries and Aquaculture has declared a closed season on fishing for both industrial and artisanal fishermen in the month of August. The FAO says although the measure is necessary to replenish the fish stock, investment into agriculture is also necessary to meet supply and cut down imports.
The closed season for fishing is expected to take off in the month of August as a measure to replenish the stock of fish in the country's waters. The announcement has been faced with stiff opposition from fisherfolk who are raising some concerns of potential shortage of fish on the market. But for the FAO, Ghana can meet its demand if attention is paid to aquaculture.
We believe that Ghana can produce a lot. The potential is huge, in particular aquaculture, and can meet its demand through increased production of fisheries, through aquaculture. You see, the problem with importation of fish, not just fish, of fries or of other things which Ghana can produce. The implication is not only the impact on the foreign currency, on the hard currency, that you have to pay in dollars or in euros. And in order to get these dollars and euros, you have to, sell other things. It can be oil for Ghana or cocoa and so on. That is not the only problem. The other problem is this is paid in cash. Ghana does not borrow dollars or euro to pay for importing fish. It's paid for, which means there is a lot of markets for fish. People are willing to pay for fish products. And therefore, if production can be increased, quality and safety can be ensured, producers will not face a problem of markets in Ghana.
Current figures from the Fisheries Ministry show that out of over 1 million metric tons of fish required, the nation's annual fish production stands a little over 400,000 metric tons as of 2017.
And here we draw down the curtains on today's edition of the Marketplace and, of course, for the week. My name is Emmanuel Boaji. It's been great keeping you company throughout the week with business activities. And do join me again next Monday for more interesting developments in the world of business. Have a good afternoon.